Hello and welcome. Let's go deeper into our understanding of Singapore tax. I think in the first session, we barely covered the paper structure and what exactly does the examination look like. But to gain a deeper understanding of Singapore tax, first of all, let's understand how is it that they decide to tax your income. Because in different geographies, be it in the United Kingdom, be it in the United States, India, or any other country, there are certain basic rules that are critical for taxation. What are these rules? These rules primarily relate to how do you define income and how do you define the chargeability of income. What do I mean by chargeability of income? At what point does the income get taxed? For example, somebody could say that somebody, as in the law of a particular country, could say that this income is taxed on receipt basis. That is, you don't tax it on accrual, you tax it when the income is received. Some other country in some other head of income could say that your income would be taxed on an accrual basis. So again, you go to the accrual basis of accounting. So it is critical, first of all, to understand what constitutes income. Point one. Point two, it is also critical to understand that at what point is the income going to be taxed. Now, different countries have different ways in which they classify income, but somewhere you will agree with me when I say that income could only be from these many sources. One way of that could be employment income, what I'm earning right now with my job. Then I have put a property on rent and I'm getting rental income. That could be another source. I have invested some money in a fixed deposit or in a bond. I am getting interest on that. That could be my income. Or I have invested money in shares and I receive dividend on those shares. That could be my income. Or some of you might even go to the extent of saying that I have a property which I have sold off, and this property I had purchased for a crore and I have sold it for 1.5 crores, then there is a gain on the disposal of this non-current asset. That is also a gain, that is also an income, but it is taxed or subjected to tax in a very, very different way. That is going to be the first step in our understanding of income tax. What exactly is that? We'll first of all classify all the, or we'll first of all try to break down our income into different heads ki kahan se we can get money. We can get money from employment, we can get money from rental, we can get money from interest, we can get money from my business. I can do a trade, I can conduct sessions online and make money from that. So all of that constitutes income, and it is so important for us to therefore go deeper into the concept of income. Okay, now, in the absence of capital gains tax regime in Singapore, gains from the sale of assets that are capital in nature are not ordinarily taxable, regardless of whether they are foreign or Singapore sourced. However, refer to the new tax treatment of gains or losses. So this is a separate part. Capital gain is the gain on disposal of capital assets. So capital gains are taxed in a different way. The method of calculation of income tax there is different. However, these are basically gains from disposal of a non-current asset, like share, or they could be from the disposal of sometimes certain current assets also, which you hold for a slightly shorter duration. But basically, that gets taxed separately, not clubbed together with your regular income. The tree is likened to capital, and the fruit that is produced from the tree is likened to income that is produced from the capital. To give you an example, the property is the tree, and the rental income, rental yield is the fruit. If I sell this property, then I will have a capital gain. But the income that I get from giving this property on rent to someone, that is my income. That is not a capital gain. Income from disposal of the capital asset or the tree is my capital gain. Tree as in something that has the potential to generate future revenue and keep on generating that in the future. Like this property, if I give it on rent every month, every year, it generates rental income for me. On the other hand, if I were to talk about the rental income itself, it's a one and done activity. So your job would be to identify what qualifies as a capital asset, which they are calling the tree, and what qualifies as the fruit, which according to them is the regular stream of income. Now, fixed capital arises from assets that are retained in the business to produce profits. While calculating while circulating capital arises from assets that are acquired and are continuously being circulated in the ordinary course of trade. Up continuously being circulated in the ordinary course of trade, you would do well to recollect the fact that when you were studying inventory in financial reporting or when you were studying property, plant, and equipment, there was a distinction there. If you go back to the definition, you will recollect that when we were talking about inventory, these were items which were held for trade in the ordinary course of business. They were meant to be bought and sold in the ordinary course of business. But non-current assets, basically property, plant, and equipment, these are not held for trade in the ordinary course of business. These are not held for resale in the ordinary course of business. They are held so as to generate future income from them, so as to generate future economic benefits from them. And that is your fixed capital. Okay. Your fixed capital is nothing but your something like your non-current asset that is retained in the business for generating future economic income, whereas circulating capital is like your inventory which keeps on rotating and moving every year, thereby bringing in more money by way of trade. That is, when I use the word ordinary course of business, something that I do as a part of my daily business operations. Why do I exist? I say, for example, I own a DMart store. Then there are several items that are kept in the store which are for sale. So when I sell these items, that is your circulating capital. Whereas the shelves on which these items are displayed, the entire building in which it is housed, the cash counting machine, the machine which basically does your billing, all of that, this is fixed capital. So fixed capital usually leads to a capital gain, whereas circulating capital, that is in the ordinary course of business, that generates your income. Now, Whiteman's proposition, Whiteman on income tax, in that book, the authors have formulated the following five propositions that can be used as a further guide in drawing a distinction between income and capital. Payment for sale of business assets of a business are prima facie capital receipts. Payments received for destruction of a profit making apparatus are capital receipt. Let's understand the first one. Payments for the sale of business assets of a business are prima facie capital receipt. I am a DMart store. I own shelves. I own display counters. I have furniture. I have fixtures. All of these are business assets. If I sell them, that becomes a capital receipt. This is not an asset that is held for sale in the ordinary course of business. This is something which basically helps me to run the business, but is not sold in the business. Payments received for destruction of a profit making apparatus are capital receipts. Received for destruction of a profit making apparatus. Now, why would you physically destroy your profit making apparatus? Let's not interpret that literally. Say, for example, in your go down, uh, in your warehouse, there is a machine. Okay. That machine basically helps you to that machine basically helps you in the production process and packing. Now, if that machine catches fire, and then of course that machine is insured and you get insurance proceeds or you get insurance receipts on the destruction of that machine, then in that particular case, what would happen? In that particular case, the compensation you have received on the destruction of that capital asset would also be considered as a capital receipt. Payments in lieu of trading receipts are revenue receipts. So if I have sold something in the ordinary course of business, you see the word ordinary course of business is very important. It in a way relates with your IFRS 15 revenue, that accounting standard also it relates to. Why am I saying it? Because trading, ordinary course of business. See, I might sell my furniture also. I might sell my house also. But do I do it daily? Do I do it in the ordinary course of business? The answer is no. That is a capital asset that I sell when I have reached the end of its useful life, or it is something that I sell and then I purchase something in replacement. Those are capital receipts and they would be taxed as capital gains. On the other hand, my business is buying and selling bed sheets, for example, then that becomes my revenue receipt. That is, it gets taxed as income. And payments made in return for substantial restriction on a trader's activities are capital receipts. Say for example, I was working with another organization before this and they told me, Satyamed, you are leaving. Okay, fine, you leave. But we are explicitly prohibiting you from conducting a similar business activity in the future. So they paid me a lump sum 10 crores for it, for not conducting the same business activity for the next 5 years. Suppose that is the situation. This payment made in return for substantial reduction on a trader's activity is also capital receipt. And payments of a recurrent nature are more likely to be revenue receipts. So basically, if I am a trader of bed sheets, I am selling the bed sheets every day and I'm buying the raw material every day. This is receipt that I have in the regular course of business. This would also be classified as a revenue receipt. So, to cut a long story short, what is a revenue receipt? A revenue receipt is something that I get on my regular sale of my regular इन्वेंट्री इन द ऑर्डिनरी कोर्स ऑफ बिजनेस, जस्ट डेली का काम है, रोजमर्रा के एक्टिविटीज है. ऑन द अदर हैंड, कैपिटल रिसीट्स और कैपिटल असेट्स primarily are concerned with non-current assets in your financial statements, assets that are not held for sale in the ordinary course of business, but which are generating income as they are helpful for generating future economic benefits. They are not sold themselves, they help in creating something that is sold. That is basically the distinction between a capital receipt and a revenue receipt. Post this, the next discussion that we'll have would be on different sources of income.